It gives me great pleasure to bring on board Rahul Bhasin to talk about what his market view is, where is he picking up trends, and where the P money right now is looking for investing in terms of ideas. Rahul, oh my God, this is a different look. The lockdown look is behind.
Good morning. Well, I'm hoping that the lockdown's gone and we don't have to revisit those times again.
Well, we all hope so.
As
We
far
all
as
hope
IT
so
is
that we don't see a
concerned,
third wave at all.
yeah. I mean, if you look at history and you look at the Spanish flu and you look at most pandemics, they've typically been 3 waves. So I think to assume that there won't be one would be sort of a little foolish, I think. But with all the vaccinations going around the world and people having suffered from the second wave, I think that people will be more cautious and smarter. When one looks at the holiday crowds, one doesn't quite see that. But I think the vaccinations will help considerably. So it will be far less than the second wave for sure, even if we do end up having a third wave. And I think that infrastructure-wise, in terms of oxygen, medicines, etc., we will be far better prepared. So I'm hoping that the impact on the society and the economy will be far less than it has been. But one of the things that the COVID did was accelerate the trend towards the digital economy and working from anywhere, using cloud. The whole IT infrastructure got a big boost, and I don't think that's changing anytime soon. I think that's pretty much going to be part of our lives. And you're seeing the impact and implication on that across the entire ecosystem. I mean, you're seeing it in the IT services companies, which are catering and facilitating the change that the world is making in its business models to address this kind of opportunity which has come up. And the imperative, because if you're not digital today and you're not, I would in fact go as far as to say that if you're not digital first, your business model will get challenged and will get challenged faster than you think. And which is why I guess you're seeing all these IT companies have such a major run up. You're seeing much better order books. You're seeing, clear visibility, at least for the next 2 to 3 years in terms of the opportunity sets. And, which inevitably happens at some point in the cycle, you're starting to see pressures on the supply side, which means that, having adequate number of trained employees to cater to that demand is becoming a challenge. And to my mind, all of these things are a good thing, one for the industry as a whole, but also for India, because the industry has become such a meaningful part now of our GDP that a much faster growth rate in that would have a lot of follow-on and multiplicative impact in lots of other spaces.
Rahul, so let's spend a minute looking at IT. One is the traditional model, the IT services model. Then you got product companies which are doing exceedingly well. You got the like of Freshworks and Zoho, largely dominated by P investors. And now you got internet consumer companies like a Policy Bazaar and Zomato, which are going public. Where are you excited about?
Look, you've got to see some trends which which the digital architecture is facilitating, right? I think, when I went to business school centuries ago, our professors used to talk about, having consumer insight, right? If you look today, with all of the big data, with the ability to pass that data, the ability to capture that insight that a lot of these companies have is fairly unique. And you never had that in the past. People were always guessing. People were doing market surveys, finding, 5% of the population, surveying them and reaching conclusions. Now, some of these companies like Google, Facebook, etc., have had the ability to actually, Alibaba, to see everything that you're doing and all the time, and have almost perfect information, and they can customize their offerings to you. Now, if you look at the consumer internet companies, and I guess you're alluding to the likes of Zomato, Paytm, which are likely to make their IPO soon. Um, if you get down to the core of what they offer, and why they are so valuable, they are valuable, and they have these kind of very large market capitalizations, in spite of the fact that there's no bottom line cash flow, free cash being generated. One of the reasons is that a Zomato knows everything that you order. He knows where you spend time, what you look at. They know that ultimately when you go out and eat, and then when you go out, what do you eat? When you're at home, what do you order? So if you look at that customer insight, they can lever that in several ways. One is that they know the restaurant, they know the restaurant partners, they know how much business they're getting, they know exactly what those people are selling. So they develop this hyper pure business as a consequence. One of the other things which can happen, and if you look at what Amazon and the Alibabas have done in the the platforms, and they have the customer knowledge, they have so many products which they take.
We seem to be facing a few audio glitches there. Just reconnect and repatch with Rahul Bhasin. We want to also understand the overall landscape, what this Zomato IPO means as a precedent for other big tech internet companies as well going forward and the road ahead. Just let's mark the index then, 15,842. You've got the broader markets as well, which are pretty much neck to neck with the frontliners. Rather outperformance now with the small cap end of the market. Rahul, this, of course, the Zomato IPOs is the first of its kind when it comes to big tech internet. Nothing really comparable in the Indian stock markets, like to like, as with the company's business model. What does this mean in terms of leading the way for other big tech internet companies to start listing and make their mark on the exchanges?
I think you'll see a lot of support for these names from the institutional market. And right now, there is a lot of hype, so you'll get a lot of interest from the retail consumers. And I think the fact that retail always feel comfortable with brands that they know, and Zomato and Paytm are brands which are very well known to the retail investor. To my mind, you'll get a lot of support for both of these IPOs. I think the big issue and big challenge is that even though they have superior customer insight, which is what I was talking about, and therefore can ultimately cater to giving a superior customized experience for the customer. Paytm is similar in many ways in terms of having that insight that Zomato has. But the reality is that a lot of this will take a lot of time to play out. It's not going to happen immediately. And today, people have the patience and they're quite willing to take a lot of losses because the cost of capital is so low. The opportunity cost of capital is so low that people are saying that, okay, 5 years, this business doesn't make money, doesn't matter to me, because ultimately this is going to be a very valuable franchise. So, and by the way, I agree with that hypothesis. I think that these guys are creating very valuable franchises long term. But there is also an implicit duration call being taken by investors. Right? Now, let's flip this and say that if the cost of capital were to get higher, and it doesn't look like that's likely to happen anytime soon because of the debt loads of all the advanced economies, it's very tough to see how they can raise the cost of capital. But let's say in an Indian ecosystem, the cost of capital were to rise on the back of inflation and the political imperative to control inflation, especially before the next election cycle, you might have a situation where nearer term cash flows become more valuable relative to the further term cash flows. And I think that might be a sort of risk in investing in these businesses. But anyone who has enough of a duration profile and say, I can live with those kind of cyclicalities and would be fine. But fund managers usually don't have that kind of long-term perspective, because they end up with having to have monthly NAV reporting and quarterly NAV reporting. So I think that this will be a sort of interesting ride, is I think the best way I could put it.
Sure.
As far as
just
you
an
all
extension to the
also,
point that Rahul you're
the-
making. It's yeah. Go ahead, please.
I said you mentioned also about the SaaS-based companies, and that's a different ecosystem altogether. I mean, people wanting to buy services or the end solution rather than a product that's become a phenomenon. I mean, why in IT, the largest manufacturer of aircraft engines in the world, Rolls-Royce, gets almost 2/3 of its revenues now is from the service of providing engines which are running on planes, right? I mean, which is very different from selling an engine to a plane manufacturer or a user, or giving a guarantee. They are charging on the basis of number of flying hours of their engines. And what have they done? They've invested in IoT. They map every feature of their engine. They can do preemptive servicing. So the whole ecosystem's got more efficient. But if you see that trend, it's not only in software. I mean, I'm saying there's a wider trend across the world where people are wanting to pay for services, not put the capex down up front. And it's the what I call the life cycle management, which is becoming a bigger trend and a bigger opportunity set. And I think that you will see businesses who adopt this do very well going forward. You'll also notice that this whole life cycle management is going to extend, and I think you'll find over time, first maybe the Nordic countries, and then across time other countries. I think you'll find lifetime liability of companies for their managing their products. If somebody sells single-use plastics at some point, they'll be made responsible for recycling it, right? If you sell household chemicals which pollute the environment, there will be rules and regulations which come up which prevent degradation of it. Now, this entire life cycle management, to my mind, will lead to a lot of innovation, and companies which are ahead of the curve on some of these things will, to my mind, do really well. Apologies, I took you away from IT for a bit.
Right. Rahul, just a takeaway from the points that you were earlier making about these large IPOs which are bound to hit the markets. There's Zomato today, but there's going to be Paytm, Policy Bazaar, Nykaa up next. We've got a slew of Indian internet companies slated to IPO this year itself. Is valuation even the right parameter to be looking at? Because many thought that Zomato has come out with its IPO at exorbitant valuations. These businesses don't even make money right now. But we've got history in the names of Amazon, etc., which have sort of set the benchmark that even if these businesses don't make money today, they are going to generate enormous amount of revenues on the long haul. So in that sense, would valuation be the right parameter to be looking at for a long-term investor who's looking at these IPOs?
Look, I think that it would be very foolish for any investor, and especially for any professional investor who has a fiduciary responsibility to and is entrusted with other people's money, to not look at valuation. I mean, it is very, very important. So you have to understand the business case, you have to understand the competitive landscape, and you have to understand how they'll be able to capture value. Now, Zomato also has a take rate of almost 30% odd, right? I mean, they capture a fair bit of the value chain. Now you have to ask yourself, is that sustainable? How is that likely to grow? Where is the market penetration likely to be? How much can they capture from businesses like Hyperpure, etc., which to my mind is a fantastic franchise? When will all of this translate into the bottom line? And what is the risk of all of their delivery guys who are currently supposedly contractors? Where is there a regulatory risk that they all might be forced to be on the balance sheet of the company? What are those risks associated with those cash flows? And how sustainable is, can they actually execute upon the cloud kitchen idea because of their superior insights and actually capture more of the value of that entire ecosystem? Will they succeed in the grocery franchise, which they're doing because, again, of their superior insight and as an extension of their hyperpure business? These are questions that every investor needs to ask himself and put values and probabilities around it and look at probability distributions and then arrive at valuations. And just saying that this is hot and sexy and doing it, I think would be careless to my mind. And the reality is that they've built a phenomenal franchise. It's difficult to envisage how anyone can shake the duopoly of a Swiggy, Zomato. But I think it's important to think of one thing. I mean, if you look at the Fortune 100 companies, if somebody got into the Fortune 100, they typically earlier, 100 years ago, they used to stay there for at least 35, 40 years. Now, on average, they stay there for 14 years. Right? So business models are evolving faster. Now, the problem with business models evolving faster is that when you're looking at cash flows coming out to you 4, 5, 6 years down the line, which you're going to then do a present value of, you have to be very alert to any kind of disruption which might happen. I don't see that. And like I said, I think that these are fantastic franchises. They have adopted what I call the frictionless model, which is it's a very big trend. Customers have become very allergic to any kind of friction they have in fulfilling any kind of transaction. Zomato's thought that through and has made it really easy. Uber's done the same thing. Paytm's done the same thing. They've made bill payments so easy, etc. That hassle-free, making things hassle-free for the customer has a big valuable franchise. And I think that that's something which these companies have adopted, and they have created value. But I think it is imperative that people look at how that value will translate into economics and look at the present value of that and under different market scenarios and at different costs of capital. And I think that's the only way you can make a reasoned judgment as far as these things are concerned.
So Rahul, our audience is public investors. They are perhaps hearing the conversation, trying to understand from you that, how to value some of the companies. My question to you is that Zomato, Policy Bazaar, Zoho, Nykaa, some of these are great companies, formidable franchise. But by the time they will go public, do you think for a public investor, the money or future returns are going to be very less? Because large part of the re-rating has already happened in the public market. And when these companies, they go public, they will not go at throwaway price. This is not 1992 when Infosys or a Satyam or LCL Tech went public.
I think that, the first thing I would look at is that when do investors make money in IPOs, right? Typically, you have very smart people selling shares in IPOs. So do they typically leave a lot of value in IPOs? And if you look at historical data, not just in India, but around the world, typically investors make a lot of money in IPOs at the end of a cycle where you've had a dry run and no IPOs for a long time and adverse market conditions. For the first 9 to 12 months after that period, usually investors make a lot of money in IPOs. And then that probability of making money starts to decline quite quickly. So if you are, past that period where 9 to 12 months have gone, typically, and I'm not alluding to these particular IPOs, but typically then assets tend to get more fully priced and leaves far less on the table. And I think that you are seeing that generically as a trend. The other issue, to my mind, with a lot of these businesses which are coming up is they have attained a certain scale and they have addressed a certain market. Now, in India, one of the big challenges is that how big is the addressable market? And I think that's the biggest question. And I think that if one looks at it from a 10-year perspective or a 20-year perspective, I think the addressable market is fantastic. But if you look at it here and now, and you look at the addressable market for a lot of these companies in terms of where they can capture value from, not where they can do business, but where they can actually extract value from. I think the big challenge is that the size of that market is actually much smaller than a lot of people think. The people with the wallet power of California, for example, is 1 crore people. Now we are a very large, now 10 million in a population of 1.3 billion is a very tiny number. Now people say that there are 800 million people using the internet in India. Sure, maybe. Maybe once a year they do it to recharge their phone or to book a train ticket or something like that. But if you look at the people who purchase things regularly from an Amazon, Flipkart, all of these things put together, and when I say regularly, I'll say once in 2 months or once in 3 months, that number is very, very tiny. It's about 10 odd million. So I think one of the challenges you have is that implicit in a lot of these businesses is this assumption of hyper growth. And I think that unless the per capita GDP and the purchasing power were to increase, I think that hyper growth assumption may be a little challenged. So I think that's another big risk that these businesses have. But on the flip side of it, if you have capital, you have patient capital, and you can see that a lot of these franchises are going to be very difficult to shake. I think in Zomato's case more so, in Paytm's case with Google Pay, Phone Pay, and a lot of other names, I think they're maybe that franchise value, that moat is not quite as strong. But I think that's another risk and challenge that people have, and they need to address it. I think the addressable market size, and I think it's very sad, but we are still a poor country at the end of all of this, and we're leapfrogging on technology, and I think that's a fantastic thing. And I think that a lot of the unicorns being created and is going to, and the software industry growing is going to have, like I said, multiplicative effects. But it'll just take a little longer, and therefore, increasing the size of that addressable market will also put a sort of cap, and should put a cap on the valuations that investors should be ready to pay for some of these names.
Always a pleasure to have you on ET Now.